Hello, everybody, and welcome. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo, and soon to be one NRE, one National Real Estate, so we could be doing these webinars nationwide. So anyway, I just want to welcome everybody, and today I want to thank everybody for registering to hear the webinar, How to Scale Up to a 1 Billion Real Estate Portfolio. Michael Ramin from Sharestates interviews Allon Avgi on how private money helped scale his business and became more bankable while still leveraging private capital for non-conforming projects. Our sponsor today is Sharestates. Sharestates is a national private hard money lender that offers financing solutions for a variety of needs and situations, including heavy rehab of commercial properties, residential fix and flips, ground up construction, and rental loans. Their lending guidelines are flexible, including loans amounts ranging from 100,000 to 20 million, with maximum loan to value of 90% purchases, 100% rehabs, competitive rates and terms between 6 months and 30 years. Sharestates provides loans for single family, multifamily, apartment, office, retail, and mixed-use properties. Very nice. Michael, at this time, I'd like you to give us about a minute as to who you are, what your position is at Sharestates.
Awesome. Anthony, thank you again to you and to the New York State Real Estate Expo for putting the webinar together, and for Allon for joining us today and letting us hear his story. A little background on me: I'm the Executive Director of Sales for Sharestates. I've been with the company since almost day one. And I help us grow our originations platform. So meeting direct borrowers, brokers, and different correspondents that work with our products and programs, we're able to scale up the company. To date, Sharestates has originated and closed a little bit over $3.5 billion in loans. That's in the last 4 to 5 years. The idea is to keep growing our platform and help real estate investors scale their business, whether they are doing a 1 to 4 family fix and flip, working on a larger multifamily project, or just trying to get permanent financing for a rental property. We've worked with investors similar to Allon, first timers, more experienced guys, and people that are, transitioning from maybe being in that 1 to 4 family space and going into mixed use multifamily and the next step from there.
Great. Thank you, Michael. Thank you.
Absolutely.
Allon?
I'm the founder of Avgi. My name is Allon Avgi. I have been buying real estate, redeveloping, repositioning properties in a couple markets across the country over the last 5 years. I started Avgi when I think I was a sophomore in college, when I was going to Hofstra University. And I started with one house in Long Island, which I refinanced with Sharestates. And since then, I've scaled to about a $70 million holdings portfolio. And we're going to hit 100 million by the end of this year, on track to $1 billion within the next 4 years.
Very impressive. Very impressive. Congrats, Allon. Congrats. So once again, Michael, without further ado, Michael Ramin from Sharestates.
All right. Thank you, Anthony. And thank you for joining us today. Allon, appreciate you taking the time out today. I know you love speaking, so this works out well for all of us. I know you gave us a quick snippet of what Allon Avgi has turned into today, but I wanted to go back to maybe before Avgi started. So before you got into real estate, what was your goal before that? So I know real estate started sophomore in college, but until recently, I don't think real estate was one of those things that when you're a kid normally pick out being a firefighter, a police officer, a doctor. So what was the goal before real estate? And then maybe tell us what caused that pivot for you to move into real estate.
Yeah, my whole life, I didn't just want to be a landlord. I wanted to just be a businessman, a successful entrepreneur since I was a little kid. So everyone wanted to be a fireman or a police officer. And I just wanted to have a big, successful company that a ton of people worked at. And I didn't exactly know what it was. When I was really young, I actually wrote a business plan to open a bank. And then I met you and decided I don't want to open a bank. So I kicked off my business career in e-commerce. Nobody could tell how old you are behind a computer screen. So I used to drop ship products before it was the hottest thing since sliced bread, right? And I used to drop ship big furniture. And it worked out. I did pretty well as a kid. I made enough money to buy my own car, pay for college, pay bills, and just have some money to have a little bit of fun. So that income at a young age got all that stuff out of my system. Now I'm way more interested in just building something beautiful, and I have no interest in anything fancy at all.
And then what got you to get into real estate from that? So I know you had the income from that, and then was it just like, hey, I found my first property, this is cool? Was there something financially motivating? Was there something within family? What made you get into that next step?
I had startups and they kept failing. So I kept losing all my money. And after losing my money 2 times, and I've lost my money more than 2 times, which doesn't scare me at all. It doesn't bother me. It's part of the process. But when I kept losing money, and a lot of money for me at the time, like once I lost 30,000, the following time I lost 100,000. That was all the money I managed to save. I quickly scraped together $40,000 from e-commerce again, and I bought my first property to be stable. I thought to myself, I'll buy one house. It'll bring me a couple $1,000s a month, a multifamily, and then I'll be able to go out and start another startup, and nothing could stop me, right? Because I have a multifamily backing my lifestyle, my rent. What's my lifestyle? My rent, my car, my phone bill. And that's not how things turned out in the end. I fell in love with the business, and I just scaled it as much as I could.
All right. What was the first property you purchased? So was this a single family home, a 2-family?
Yeah, a single family home in Westbury that I rented out, like the bedrooms on, and just basically house hacked it, except I didn't live there. And I bought it with hard money. I didn't even know I could take FHA loans or how any of that worked. And I had no income at the time. So shout out Sharestates DSCR financing. But back then I didn't know how it worked. So I just figured I'll buy this house and I'll sort it out.
All right, awesome. And then after you bought like the first house, what was the motivation to the next step? What made you decide, hey, I got this first, single family rental home, and I've seen the properties you've purchased now, and it's crazy because a lot of people do focus on sometimes a property or geographic location, but you guys have gone from single family homes. I've seen 2 to 4 family homes. I've seen multifamily properties. I've seen mixed use now. I've seen commercial, strips and everything like that. I've seen all that in New York, and then I've seen now out of state. So again, the single family rental play out of state, and then finding multifamilies, garden style type apartments. What got you to pivot from this New York market, maybe a little bit, go into other markets and different asset types?
Well, New York rental laws are horrendous. They just keep getting worse. I'm not kidding. It's like the worst place to own residential real estate. I mean, the money's great, right? You're getting much more per door, but the downside is just brutal. Like I had a house fire, and till now we haven't settled the case. It's been years. I haven't gotten paid out on it. And it's been a mess. It's been a mess ever since this started. Everything in New York is difficult. So I figured, why not go to a different place, right? And so I started buying in St. Louis. I started buying in Memphis. I started buying in Detroit, Arkansas, Houston. And then I realized I'm spreading myself too thin. I pulled out of a couple markets. I hyper-focused on the few that I was in, and everything's a learning curve, right? So learning that what markets work for me and what boots on the ground I have and infrastructure works, that's where I decided to focus on. And that helped me scale with more rental friendly laws. But then you recognize the downside, right? You're not going to yield as much as you will in New York. So there's a give and take on everything you do. What is crucial for any real estate builder or anybody that's creating a real estate investment business is that you need to be asset class agnostic, right? You need to be able to go into like multiple different asset classes. Because if you pick one, you're going to get hurt. There's no way around it. You're either going to get compressed by cap rates, the laws are going to hurt you in the market you're in, the market's going to change rate wise, and you're going to have to reposition. I mean, we know some people, Mike, that they were only in single family, and when the rates shot up, they could no longer flip single family. They went from doing 200 flips a year to maybe 30 flips a year. And I buy and hold. So I could buy retail, I could buy multifamily, I could buy single family. It's spreading yourself out there. So all your eggs aren't just in one asset class. They're in one basket of real estate, but many different colored eggs.
All right, awesome. Right now, would you say you have a favorite asset class or geographic location where you guys are looking at?
Right now, my favorite asset class is industrial in New
Industrial.
York.
Industrial. So you're looking at warehouse, like dry use storage, anything like that?
Correct.
All right,
Yeah.
awesome. And if
That stuff is flying off the shelves. There's no product. It's very easy to deal with. I mean, I had a garbage truck just drive into one of my buildings. That was pretty weird. But other than that, it's very easy to deal with. Like, it's a walk in the park compared to residential in New York.
and then most of those you just rent out, triple net to tenants, and that's it. Just sits there in cash flow.
Yep, you
Right.
bill back the CAM, right? So it's not like residential. I mean, I have like over 60 houses in Long Island, and you can't bill back the taxes. You can't bill back the snow removal. And, you know, your liabilities through the roof. I'm still buying houses. I'm buying a house today, you know, but it's a great deal. I know there's 30% upside day one. That's why I'm buying it. But that's the last house I have in my pipeline. Right now, one of my guys is working on a 51 house portfolio that I'm interested in, you know, something bigger, but one at a time. I'd rather focus on one industrial project at a time.
All right, awesome. And the 51 house portfolio, is that something you're still focusing on in New York, or is that out of state?
That's out of state, and don't worry, you'll get the financing for it.
Not worried. All right, awesome. I think what's very cool in the real estate market, a lot of people always talk about the craziest deal. I've worked with borrowers now for about 10 years through restructuring and working on loans with them. And the craziest thing I've ever seen is borrowers always come, they have projects, and some fix and flip guys I've worked with buy 10 properties a month. And their mindset was the 10 they thought, the 5 they thought they would make the most money on, they'd break even on. The 5 they thought they'd, like the 3 they thought they'd lose money on, they made the most money on. And the 2 craziest ones, they always had stories from. So, I mean, you guys now up to being under about 70 million in assets under management. What was the craziest property that you either got into contract or working on a flip, or just blew out your expectations with how much you were able to make on it and get it to the next level?
Profit wise, you're talking about?
Either profit or crazy story from walking into a property, seeing it and getting it to the finish line. Or I know there was a couple other properties you dealt with issues, whatever it was, but.
Oh man, if we talk stories, I've got a lot to talk about, but I'll give you one that we're taking to the finish line right now. That's probably one of the best projects I've ever done. It's a mid-sized deal. I bought 4 buildings in Long Island in a strip. It's a mixed-use property. I like mixed use a lot because it's you're finding like a needle in a haystack. You know, the apartments are under rented. Typically, the owner ran the store. They're no longer running the store. They left because of COVID, or they moved down south, and they're selling the building at a discount. They just want out. I'm buying 2 more projects like that now. I bought about 7 of them in the last year and a half. I bought these properties thinking that I was going to basically break even on the refinance. I thought I was going to invest 1.4 million, cash out my 1.4 million in about 2 years, 3 years, and keep moving. The DSCR would be through the roof. The rent's going to be fantastic. But what I didn't realize was that every unit had an attic. So the units are on the 2nd floor. The stores are on the 1st floor. Every unit had an attic that went up to a 3rd floor. I didn't know there was a 3rd floor. I had no idea. I thought it was just like a part of the facade. Like you can't see the roof line from the front of the building. And I don't get inspections because I tear up every property anyway and renovate. So as we're renovating our first unit, what we recognize is that you can create another 2 bedrooms on the 3rd floor. You don't even need sprinklers or anything in this township. Everything's totally legal, especially if you keep open like a loft style rather than closing off with sheetrock. So that's what we did. Instead of creating 2 big bedrooms, we left every single unit in this place. I'm talking like I have like 20 something apartments over there. They got a loft in the unit. So rather than getting $2,000 a month, every tenant that's walked in the door now is getting a premium product. They're paying me like $2,800 a month. So my rent, I expected $1,700 to $2,000. Now it's become loft units. I didn't know this kind of demand was in this market over there. And long story short, my rent's gone up by a good $20,000 more than what I thought it was. So in the end, I'm probably going to cash out north of $1 million on top of my initial equity in the deal. And some people might say that's over leveraging. To me, it's more capital to buy more deals with. It's not going into fancy cars or watches. I'm just going to buy more multifamilies with it anyway. So.
All right, that's awesome. And that was something not expected. So it's a lot of times the unexpected in real estate isn't a good thing. And to have something like that happen is pretty awesome.
To put it into perspective, by the way, the properties I'm all in for, say, $4 million. I thought the properties were going to be worth 5.5. The way it looks like right now is we're going to be north of $8 million on the appraisal.
Oh, wow. That is awesome.
Major home run.
All right. Next question is, and I think a lot of people that are listening today are going to want to know this because being on the lending side, I hear this every day from a lot of the borrowers and brokers we work with. It's going to be a dark winter. I can't find deals. I can't find good deals. This market in general has changed a lot in the last 9 months. From January till now, our DSCR rates, to give everyone an example, were in that 3.5 to 4.5 range, and now you're in that 6.5 to 8% range. So you've seen a big jump in those rates. Also in the market, just deals in general. People finding deals, finding spreads, and finding a qualified buyer even on a fix and flip. You've had rates in that market go from the 2s to almost 6% on a conventional mortgage now. So what the market has changed a lot. So like, first of all, I want to know what you think are the pros to the market changing. So a lot of people find we've had borrowers like our fix and flip rates were in the 7s and now are 10 plus now. When we first started, our rates were 12%. And investors took it. Those same investors still, their rate doesn't bother them because they find the spread in it. So everyone thinks there's maybe only cons in a market, but there's definitely pros. So I wanted to know what you think the pros are in this market. If you think there's any cons in it, how you guys are finding deals now. So, and I know some of the ways you guys find deals, and I'll probably get to that in another section. And where and what are you pivoting to?
Great question. I started borrowing at 14%, so 6-7 doesn't bother me at all. I'm a cheap Jew regardless, so I'm still fighting with you on every nickel and dime. But regardless, it doesn't bother me at all. I think the pros outweigh the cons big time. And for those that don't, they either haven't been in real estate long enough, even though I'm only in the game for 5 years, or they're not realistically adjusting to the market. You got to capitalize on what you get. So right now, what are we getting? There's a lot more opportunities popping up. I mean, wow. Like, I remember this when I started, there was a lot of opportunities then it tanked, right? As rates went down, the opportunities became slim, and that forced me to build out an incredible deal sourcing machine, which I thank God for every day that I had the ability, and I got to live through that, right? The rates going at record lows, because then it forced me to pivot and build out my systems and processes and underwriting even better. And now it's like back to 5 years, 6 years ago, where the opportunities are through the roof. We can't raise enough capital to keep up with the amount of great deals we're seeing. And people are like, what do you mean great deal? I'll give you this. I just put 2 deals under contract in the last week, with another one coming today. Multifamilies in Long Island at around $110,000 per unit. Their value add 12 caps. I'm going to see a 12 cap in this market. So even with commercial rates at 5, 5.5, 6, that doesn't bother me, because 6 months ago, a year ago, I was buying 6.5, 7 caps. I'm just adjusting,
Makes sense. These properties that you're finding like this, this is a good question a lot of people ask. And when we get loan applications in, we ask our borrowers, why are you finding this deal? So like, is it been poorly managed? Has it old management? This is what I've seen a lot of recently, where people are finding opportunity in poorly managed and, older management companies or older families owning properties for years, where it's getting to the point where they've owned it for 50 years. And now there's 7 kids involved, and the 7 kids can't decide who owns it. So we're going to sell it and split the money. And then the properties also that you're finding, are they distressed? So how much work do you have to put in for each unit? So how many units is this multifamily?
There's two separate ones. Both of them are 5 units.
Five
Both,
units.
yeah, give or take. There's garages, there's warehouses, whatever. But let's say both are 5 units. Both of them are totally separate scenarios. One is just, and this guy's old, he wants to move on. So he's moving on and he's selling to me. No problem. He's self-managed, under rented. Properties are in mint condition. So I wouldn't say poorly managed, just under rented.
Okay.
The other property, her husband was running her properties. Her husband runs all the deals, everything. He passed away. She's liquidating the portfolio. There's a lot of older people that are selling and moving on, whether they're moving down south or they just want to stop managing because the laws here are no longer friendly. And for those that don't know, in Long Island, you used to be able to go to the courts yourself. Back when I started, you could go to the courts, submit an eviction. It takes you 2 weeks to get heard. Then you go in front of the judge, 2 months, 3 months, maximum 4 months, your tenant's evicted. Today, we're sitting on tenants for 2 years in Long Island that haven't been evicted because you need lawyers. By law now, you need a lawyer. You have to serve notices. The New York City rental laws trickle down to the island and upstate, which just changed everything. So a lot of people are fed up and they don't want to deal with it.
All right. And then when you guys are sourcing these properties, do you look for your properties to be close to other properties you currently manage? Or if it's a good deal, you're like, we'll take it and, management company will move around, work on it like that?
Yeah, we hire professionals. So as long as it falls into our underwriting, we do it. I'm not looking for any specific locations in Long Island. Outside of Long Island, I'm buying in Houston, Arkansas, St. Louis, and that's about it.
Okay, awesome. And then none of these properties are distressed, so no construction involved. You just have to update management and good to
A
go.
lot of construction involved in a
Oh, a
couple.
lot of construction involved. A couple of. So one of the multifamilies now or different properties? Out of
Yeah,
state?
2 separate multifamilies. One of them, $350,000 construction budget. The other one, $25,000.
So not bad.
Nothing.
Quick project, move on, update rents, refinance, on to the next project.
Yeah, the other one is a heavy lift though. 350K, a lot of work.
All right. A lot of the projects you mentioned still have been in New York. Do you see any areas outside of New York that you would suggest to new investors or people that are listening from out of state that you've found success with, that you say, hey, I'm finding deals here? Say, hey, like I've been seeing a lot through different reasons within our lending, but is there something that you're seeing or an area you're seeing that's hot?
Everyone keeps talking about the areas, but I'm telling you, it's less about the areas. It's more about the boots on the ground. If you go into Virginia or you go into South Carolina, you're going to see the same metrics. You're going to see the same type of population growth and job growth and everything. But what's the differentiating factor is who's managing those properties for you and how well are they performing. So, for example, I've switched 3 managers in Houston until I landed on a good one. My Arkansas managers, the first manager I got has blown it out of the park. By far the best manager I have. So I'm driven to buy more properties in Arkansas now because I'm at 100% collections. I'm at 98% occupancy. We're turning units and raising rents. Construction's very light and very fast. The landlord laws are very friendly. But in Houston, I need to grow into these management companies. I need to make sure everything's set up properly and working accordingly. Otherwise, I got to switch them again. So it's less about the areas, more about the people. Otherwise, go to Tennessee, go to Arkansas, go to Texas, all these places, it's no brainers. Everyone's going there. It's very easy.
Okay, sounds good. I'm going to pivot the conversation a little bit right now. I know you are huge on social media. So TikTok, Instagram, Facebook. I think you're on Twitter also. Spotify, your podcast. I think I've done a podcast with you that's on there as well. I've seen a lot of people in their businesses today, social media, they're using it for everything, for whether it's getting investors, finding deals, anything to grow the company or just to get an eye on your business. How has social media affected you and your business today? And is there anything you can suggest to people that are listening and say, hey, like this is amazing. I use this platform is better than the next, and why?
Yeah, social media is huge. Anybody that doesn't use it is just doing themselves a disservice and their company. I don't have the privilege of being born into a generational business for me personally, right? A lot of people have. I'm now getting the credibility that people that are third, fourth generation in this business have because of social media. It's what sets me apart, right? At the end of the day, real estate's real estate. It's pretty cookie cutter. You're going to build, you're going to rent, or you're going to renovate. You're either raising rents or you're building to rent. You either sell or you refinance. There's not much more you can do. I mean, there's creative startups, prop tech, and interim, but social media is how to get out there as far as possible and let people recognize the company culture you have and let them know exactly what you're doing. So that's what sets me apart from a company that does exactly what I do in Long Island. TikTok's huge. I found a couple deals through TikTok. Instagram is my favorite platform just because it's my era and I'm very good with the platform. I keep trending on the platform, and I find investors and deals through Instagram very regularly. I've probably raised $3 million on Instagram alone. And LinkedIn is where all the working professionals are. So you need a LinkedIn presence because people are going to send you deals, investors, whatever you need through LinkedIn. And yeah, I'm obsessed with social media. You know that. You're also heavily involved in the market.
Yep, definitely. Another question to ask about social media. What has been the most successful for getting followers and posts? Like what kind of posts? Because I've noticed all your posts are not about real estate. You share stories about driving in your car just randomly, seeing whatever it is out there. You from eating a sandwich to getting on an airplane to doing something with friends and family. So you do show your personal life. You do show your professional life, and then you do have little, whether it's little videos, snippets, etc. You suggest all of that for somebody that's trying to get that presence out there and have people follow them. Are you hesitant on posting anything? Like, I shouldn't post this if people are going to think it's stupid. Or you're like, just put everything out there and it is what it is.
Those were a couple questions in one, and actually they were a good one, Mike. Good questions. I'll start with hesitant about posting. Yes, I used to post anything and everything, and I've stopped. Really, unfortunately, because I do not hide anything from anybody. You know me. I am very direct, even if it's insulting. And man, let me tell you, I post something sometimes and people react the wrong way. And it's just not, you can't do that. You know, like when you get political, you might lose. I lost investors on politics. And honestly, I told them it's all right. We disagree. And I'd rather not work with you. But hindsight, that was a mistake because business is business and your personal life is personal, right? So obviously I'm from Israel. I'm a supporter of Israel. Now, people battle with me on that all the time. And I'd love to have conversations about it, you know, normal conversations. But when you post out to the masses opposing another group, you have major issues coming back to you. Rather than opposing now, I'll just post pro-Israel stuff rather than opposition stuff. That's an example. Other things include like when the whole BLM thing was going on, you know, and supporting people. You're going to love this example. I have Black tenants, African-American tenants, and they started coming up to me and telling me, you know, BLM's going on. I don't know if I can pay rent. There's a lot going on. I'm like, one thing has nothing to do with the other. Don't use that as the excuse as to why you can't pay rent, right? I rent it to you no matter what color you are. Black, green, orange, yellow, or white. I'm renting to you. All I care about is that you pay your rent. That's it. And people had an adverse reaction to that. Like, you'd be shocked. People freaked out. And I'm like, why are you freaking out? I rented to these people, you know? Would you rather not rent to them? But that's the way I see things. Maybe that's the way you see things, but that's not the way everybody sees things. So I'm definitely hesitant to post everything now, unfortunately. And maybe when I get bigger, I'll start again. But until then, institutions don't look at you the same way. They're scared of you as like you're a loose cannon. So I can't be seen that way as I'm scaling. I still post everything that I want to post that I know won't trigger most people in the masses. Other than that, I think that you need to be genuine. That's key. A lot of people are just like, I'm going to teach you this. You know, not everyone wants to learn. They just want to connect to a person that they can relate to. And my story is very relatable, right? I started with nothing and I'm doing pretty well. A lot of people start with nothing and they want to do pretty well. Those are the people I connect with, you know?
Makes sense. And thanks for sharing all that. Next question, get out of real estate a little bit. Maybe tell something to everyone listening that they don't know about you. So I can ask a lot of random questions, but if there's something that's not related to real estate that you can tell people about you that probably won't embarrass you too much, or maybe whatever it is there something that you want to share about yourself that people might not know about you?
Yeah, I'm really good at taking second. I've always taken second at everything. Second in ping pong, second in every event in my high school, second in every tournament I've ever been in. So I'm always driven to take first now. I've always been driven to take first. And I think the fact that I constantly take second is what drives me to just be better all the time in everything that I do. And in real estate, this is real estate related, I'm looping it in. I want to take first all the time. And although it's not a competition, in my head it is, right? So all these people out there, all these market leaders and everything, I want to be first. I want to be up there with them. So even if I fall short and take second, I think I'm going to blast past my goals. But the fact that I constantly take second drives me crazy.
All right, awesome. If you can be a fly on the wall in anything in history or a moment in history, what would you, was there a time you could pick or anything or no?
Oh man, that's a great question. Probably when Michael Ramin met his wife. I'd love to see the game Michael Ramin has when it comes to finding a significant other.
I just swiped right and she said yes. So. See much over there. So that worked out well. Outside of that, if you can, this is actually a crazy, if you can be a TV character, whether it's a cartoon or somebody in life, is there something that you can pick and say, hey, I want to be that person, or it could just be a different person in life?
In life, if I could pick to be somebody else, not really. I love my life.
So then if you want to pick someone else, if there's someone else you can meet, dead, alive, or whatever it is, or a fictional character, who would that person be? And it can't be me. You already met me and you saw my wife.
Maybe, Carnegie, Rockefeller, one of the original businessmen that led the nation in growing something major, Ford, one of those guys. And you know what? If I could pick somebody else or something else, I'd pick to be a little kid again. I just would love to be a little kid again,
Yeah.
Not because I regret anything, just because that point in your life is so beautiful and you can't go backwards. And now as you get older, you realize, wow, this is what's going on for the rest of life. You work, you travel, you meet people, money's not everything. And being a little kid and just cherishing that stuff, it just passes by so fast.
All right, awesome. I'm going to get to one other question, and then we're going to take questions from everybody listening. So right now, 70 million, 100 million by the end of the year. 4 years, you want to hit 4 billion. 1 billion, sorry. 4 billion would be great in 4 years. That'd be amazing too.
Would be nice.
How do you see yourself getting there with this market that's going on, rising interest rates, people talking about recession or possible recession, inflation and all that? How do you see yourself getting to that number? So you have to hit essentially another 200 million a year in the years coming up. How do you see yourself getting over there?
I think that I'm going to get there by standing on the shoulders of giants. If you ever heard the saying, I can see farther by standing on the shoulders of giants. So the farther that I'm going to go farther, I need to work with bigger players, meet more people and good people. And the people that I'm working with right now are monsters in their industries, and they're constantly connecting me with more and helping me do better. And by me doing better, they're doing better, of course. So by leveraging giants and standing on the shoulders of giants, I think that's how I'm going to get to where I want to be.
All right, awesome. I saw a quote today on someone else's page that will relate to that. It says, success is a wall. You have to just keep going. So hitting success is great, but you got to keep going from there. Anthony, I see you jumping back on here. Is it cool with you? I can start asking some of the questions that came on earlier on to.
Oh yeah, I was just going to come on and I was going to read them off to you guys. And but geez, Allon, I was disappointed with that one question Michael asked you as to who you want to be. I thought it would be Anthony Kazazis.
You did say you were the nicest guy you ever met.
So let's start off with, there was one question as for you, Michael. Are you a national lender? Do you
Yes,
lend
we
in
are
all
national.
states?
We
Okay,
are in 44 states. Some of the states, they don't work for licensing reasons or other reasons. We just don't want to be in them. But we are essentially national, being in 44 of the states. We're not currently in Alaska, North and South Dakota, Vermont, Nevada, and I think it was Oregon or Utah was the other state.
okay,
But
okay, good. Yeah, maybe you could have Justin send that over to me as to what states, and I can send it out to everybody, okay?
all right,
Just in
absolutely.
case. All right, that'd be cool. Olga Rogers, and so nice to know that there are nice people in the real estate CRE in the big league. So that's a nice compliment from
Sure.
Olga Rogers. An anonymous attendee, do you personally back each deal? And how do you structure your financing to buy multiple deals?
If by back, that means personally guaranteed, then the answer is yes. Any deal that I'll do, I'll personally guarantee. The financing, basically the capital stack is different on every single deal. So for example, those two small deals I talked about earlier on the webinar, I'm self-funding those. One of them, I'm getting the debt from a institution, right? A bank, a local lender, they're lending me the money. That's more of a normal loan. And the other one, I'm going to take hard money on and fund the rest myself. Maybe I'll resort to Michael Ramin over here for the hard money.
How are you financing construction rehab looping in loan?
That's a tough question too, right, Mike? Right, Mike? Sometimes
Uh,
yeah,
yeah, I mean, usually construction financing is put into escrow. Sometimes you'll get up front, but it's usually worked in. Borrower completes the work, they do an inspection, and they release the money out to them on a loan. So that's how it's normally financed. I have seen other stuff done in projects. I've seen people buy a lot of projects, they've owned it, get approvals. And sometimes there's enough skin in it, and the person's got a strong enough track record where they don't mind paying interest on a larger loan amount, and they'll take the cash out day one and just work at their own pace, sometimes faster than other people. So you do see a mix of how actual construction financing is done. In the private lending world, there's different ways you can do it.
it's a good question because the answer is not what you'd expect. It's different for every deal, right? And every borrower. So there's no right way to do it. So I hope that's not in anybody's head like this is the right way to do it. There is absolutely no right way. There's a project I'm doing in the Hamptons that every lender wants to give me all the construction money up front. So immediately I have the entire construction budget set up. There's other lenders and other projects that I do that they want to do it against a draw. So for like what Michael said, you do the work, they reimburse you. You need to raise that money or have that money at hand before you do that project. Or if you get it all up front, that's a different kind of lender. It's whoever you go to and whoever you land on at the end of the day.
Okay. What do you look for in managers? Just rent collection or more?
So much more. I mean, my poor managers have to go through like a hiring process that we put them through. We audit their software. If they don't utilize any of the mainstream softwares that we connect to, I won't work with them. I usually find managers through referrals. We inspect their work. I have a back office that audits the books every single day, and we do weekly checkups with them. Yesterday, I personally was on a 4-hour phone call with our new property management company in Houston, reviewing everything. My in-house bookkeepers audited them. In the beginning, all I do is look at their software they use, get an understanding of how they work, and get a referral from them, either from someone else to work with them or from them. Now it's much more in depth. Good question.
Very good. Do you incorporate each property separately or all under one corp?
Depends on the size of the deal. Michael could probably also speak to this from a lending perspective. What I have 10 houses in St. Louis. Michael is probably doing the financing for me. Actually, you did do the financing for me.
Yes, that is.
That was under one company, all under one, 10 houses in one shop, but those price points are around $75,000 a house. So it's low. In New York, when I'm buying a house for $500,000 or a $5 million project, that goes into its own entity.
Yeah, there's different reasons. Most of the time, we will tell borrowers to put them into separate entities. It's more for liability reasons. But if you are buying a portfolio, like you mentioned, a lot of times people put that into one entity that has 10 properties for one loan. We've done loans to multiple entities. So people have had portfolios where they own 4 homes under different LLCs, same ownership structure, where we've done that. But it really depends on what you're buying and where. But liability is the biggest reason. If the properties aren't connected in any way, like the 10 would be the 10 homes next to each other in St. Louis, it's probably better to buy them under different entities.
Thanks, guys. My goal is to grow my hometown of New Orleans. How do you partner for projects? My goal is to grow my hometown of New Orleans. How do you partner for projects?
Well, personally, I'm not in New Orleans, so it might not be fitting for me. But what I would do if I were in your shoes, I'm assuming you need capital, right? That's most people's issue, is I would go to local places and meet local people that potentially have money. Now you need to set yourself up in these situations. You can't just expect them to come to you. You need to go to networking events. You need to go to high-end restaurants. You're just going to meet people through the grapevine, whether it be your doctor's office, your dentist, and you got to ask. You got to have the chutzpah to say to people like, hey, I'm looking to do real estate here. I have a house. Would you be interested in being involved? If not, do you know somebody that will? And then the spider web effect will start.
But do you think, without experience, and I know before you raise money from investors, you had a track record.
Yep.
So for the anonymous attendee in New Orleans, I would suggest finding a couple projects, maybe even smaller, and going through it yourself. And even if you fail on a project, failure is always the first step to success. Without failure, you don't know what success is. So it's always good to buy a property and a couple of projects, work on them yourself, even if they're smaller, or find a couple of partners, go to fix and flip groups, find a mentor on projects, and get it. And once you have your track record, people will come back to you. We are, as a lender, like if a repeat borrower that has payoffs with Sharestates submits a loan, sometimes it might not be the best property ever, but that borrower has 10 properties they paid off. They might know something that we don't know. You're looking at the borrower's track record and experience a lot of the times. So definitely suggest building a track record in this industry is the most important thing. Your track record, your credit, and your name, very important.
Thank you, Michael.
Awesome.
How do you guys raise? How do you two raise capital? And pitch please.
Yeah, pitch please.
Right before this call, I was on a pitch with an investor, and you guys are going to love this, Anthony and Michael. I think you'll appreciate this. This woman submitted through my website, avgi.com, that she had $20,000 to invest. I personally saw the notification pop up. I sent a message in the group chat. I said, let me call. I called this girl. She didn't expect me to personally call her. And when I got on the phone with her, she automatically told me, I don't have $20,000. I said, you know what? Why did you submit? Because you're interested in real estate? She said, yeah. I said, so let me explain this to you. And I want to teach you a little bit, because one day you will. And when you do have that kind of money ready to invest, I want to be the partner you go to. So we're doing this project. This is how it looks. These are the kind of returns you can expect. I would love for you to be part of it one day. And if you know people that might be able to do that today, I'd love to connect with them. And this woman was so taken back by the generosity and the willingness to give her information for free. She baited me, and she won.
Good. That's good.
That's what it's about. You have to be genuine. You have to go out and raise. You need a corporate structure in order first. So your structure, whether you're doing a 50-50 split with investors after they get their money back and you pay them interest every month, or if you're doing an 80-20 over an 8, like that's a typical corporate structure with institutions, you need to get well versed in corporate structures and then go out and raise with that model.
Very good. Very true. Very true. What to do if property it didn't sell on your expected date?
Michael?
I mean, you can go a lot of ways. I mean, I'm assuming the borrower or the person asking this question, anonymous attendee, is maybe they bought a property, they did the work, they have a 1-year loan and their loan's about to mature and they haven't sold it. There's multiple things to do. I mean, a lot of lenders in our space will allow you to extend your loan. They will ask you questions. The most important thing, and I think Allon could even jump in here, is you have to know when you have to lower your price and just give it. A lot of people, they get invested into a property, but emotionally. And a business and emotions can sometimes cause big problems for somebody financially. If you put your heart and soul into a project, that's great. But if you think it's worth 2 million and the market's telling you it's worth 1.5 million and you won't lower your price, so those are two things you should always look at in that expected time of selling something. So a lot of people that sometimes get emotional, it ruins their business. You have to go with what's on the market, what it's expected to sell, all that. I would look at that. If you have other problems that it's not selling your property, definitely go look at the market around you. Go speak to realtors, speak to buyers, speak to everyone. Why isn't your home selling? I've seen a lot of people do work. It doesn't fit that area. It's not for that area.
I've done that. Never.
See, you can build. Sometimes someone will build like a $3 million house in an area where the homes are like $1 million, and that's like a exaggerated example, but you get the idea. So definitely make sure and market research and analysis. I know several guys that we do loans for that they are super strict and very conservative on their numbers. Like a lot of people will look at a 70% after repair value or 75. Be conservative. Look at something that'll get you down to 60 or 65. Make sure there's plenty of spread there. So I would definitely look at all that.
Good. Thank you, Michael. Sophia, Dikanis Kala, Sophia. Greetings from Athens, Greece. Do you plan to expand to Europe at all?
I don't know if that's me or you, but
I'm not sure if that's for financing or if that's for Allon to invest in Europe.
We could both answer. So I'm not expanding into Europe anytime soon, especially with what's going on over there in energy and heating prices. And I'm not well versed in the market at all. I was born in the UK, so I still have family in England. If I were to expand, it would be pretty easy out there, but it's just not for me. You can't focus on too many things, right? Like a man that chases 2 rabbits catches neither. Even scaling into 8 markets in the States was too much. So I'm scaling back, focusing on my markets, and you'd be surprised. There's people that own 20,000 units in one state. Why not dominate one place at a time, conquer and move?
So Sophia actually meant for buying property there, but
Yes.
yeah, as a lender still, she replied.
Yes.
Yeah. So answer that question. We do love Greece though. I was there a couple years ago. Highly suggested anyone listening here. It's one of the best countries I've ever been to. So.
Okay. I hope that helps, Sophia. And Christian Dela Cruz, how much interest return do you give for your investors?
Michael, you go first.
So people do invest on our website. Sharestates is a unique platform. When we first launched the company, we were a real estate crowdfunding platform. And a lot of borrowers liked it because we're able to invest into real estate debt. You get a monthly return on your capital, and you were able to have like liquidity to it. Most loans are about a year. They pay off anywhere between 8 and 12 months. And we're always able to get our investors like returns anywhere from 8 to 12% on debt annually. A lot of people like that because if you went into stock market, any other real estate, you're not able to get those returns. We still do have availability for credit investors on our platform. Not everything we originate goes there. We have our model works differently. So a lot of our loans are sold and still serviced in-house. So we do handle our draws, our servicing, and all that, and pretty quick.
I give investors a blended average. It depends on the kind of deal. Like right now, we have one deal going on that we're anticipating a 17% IRR, which is an internal rate of return, 8% interest until they hit that threshold. That unlocks my equity. And then it's going to meet those standards over the course of a couple of years. We might flip that project as a development site, and then we're expecting 150% returns. But if I promote that and don't hit it, then people like Michael Ramin would be very upset with me. So we're going to stay conservative and say 17% IRR.
Well, guys, that was fantastic. Very impressive. Michael, you'll be back probably in a month or so. and it's like a TED Talk. Michael will be speaking for about 15 minutes about all of his products. So if people want to come with a whole bunch of cases and deals that they need financing for, Michael will be able to answer it, and that will be live. Michael will be able to see everybody and be able to interact with everybody. So that is going to be a live session, as well as Allon, the CEO of Sharestates, will also be putting together a CEO message as to where Sharestates is going and where his industry is going as well. So once again, Michael, Sharestates, Allon, it was a real honor having you guys on board. And this actually concludes this webinar.
Thank you, guys.
Thank you.
Thank you, guys. Thank you, audience. Everybody be well. Bye-bye, guys.